So a lot of people buy rental properties because they are chasing cash flow, and rentals can absolutely build wealth. But the problem is that most beginners are not looking at the real cash flow number. They're looking at what's called an opportunistic number. They take the rent, they subtract the mortgage, and they assume that whatever is left over is going to be their profit. But that is not how rentals actually work. Vacancy, repairs, maintenance, management, tenant issues, taxes, insurance, turnover, capital expenses, and even the cost to sell it at some point eat into that number. So in this video, I'm going to walk you through the hidden costs of rental properties that a lot of people miss, why the spreadsheet often looks better than the actual bank account, and how this compares to land investing. Now, I want to be clear. I'm not saying that rentals do not work. They absolutely do. And a lot of people have built real wealth with rental properties. But if you're going to invest in anything, rentals, land, houses, apartments, anything else, you need to understand the real cost structure before you buy anything. So let's get into that for a minute. So at the Land Method, we talk a lot about land investing, but we also talk about real estate investing more broadly because the principles are the same and because both Genius and myself have been involved in numerous different forms of real estate investing and continue to do so. So you make money by buying right, understanding the asset, controlling your risk, and knowing your exit before you actually go into the deal. That applies to everything, including land, right? It applies to land, it applies to rentals, it applies to flips, it applies to apartments, it applies to storage units, you name it, it applies. The problem that I see with a lot of rental property content is that it focuses heavily on the upside. You hear phrases like passive income or cash flow or appreciation, right? Or tax benefits and tenants paying down your loan. And it is true, right? Those things do exist, but they're only part of the picture. The other part of the picture is the cost. And it's not just the obvious cost, like the mortgage payment. I'm talking about the costs that do not always show up in the pitch. Vacancies, repairs, turnovers, tenant problems, evictions, management fees, insurance going up or increasing, property taxes, a tax complexity that's there, the cost of your time for doing it, and again, the cost to exit when you eventually sell. So again, in this video, I'm going to go through some of these hidden costs that rental property investors need to understand, especially if you're newer and trying to decide whether rentals are the right real estate strategy for you. Then towards the end, I'll compare that to land investing just because the cost structure between them is very different. So that being said, let's start with the biggest mistake. A lot of new rental investors calculate cash flow like this, right? They take that monthly rent, they subtract the mortgage payment, and whatever is left, they call it cash flow. So if the property rents for $2,000 per month and the mortgage payment is $1,500 a month, they say, great, this property cash flows for $500 per month. $5,000 a month would be nice. It cash flows for $500 per month. But that is not a real number. That is the number before the real expenses show up. Because the property is not going to be occupied every single day forever. The tenant is not going to stay there forever. Something is eventually going to break. Insurance is not going to stay flat forever. Taxes are not going to stay flat forever. And if you're not going to avoid every repair, every turnover, every maintenance item, and every unexpected issue, that means that there's going to be costs for those things. So a more realistic way to think about rental property cash flow is to start with the rent and then subtract all of those costs that actually come with owning the property. So you do have the mortgage, you have taxes, you have insurance, you need to have a vacancy allowance, you need to have some sort of maintenance reserve. Then you need to account for larger capital expenses like needing to repair a roof or HVAC system or plumbing, electrical, appliances, flooring, and other items that are not going to happen every month, but absolutely will happen eventually if you own the property long enough. And then you need to account for management, even if you plan to self-manage, because your time has some sort of value. And if you do hire a property manager, then that is a real expense that you're paying for each and every month. Once you include all of those costs, the cash flow number often looks much different. A deal that looked like it was making you $500 per month, like we just said, may now only make $100 per month. And in some cases, it may not cash flow at all. You've probably heard of the term negative cash flow. Well, this is where this can come into play. See, if you're renting a property for $2,000 per month and all of your expenses equal $2,100 per month, well, you are now needing to bring $100 to the table each and every month. Now, this does not mean that rental properties are bad. It means that the underwriting in that example was too optimistic. See, the mistake is not buying rentals. The mistake is buying rentals based on fake or assumed cash flow. That is where people get hurt. The next hidden cost is vacancy. Vacancy is one of those things that people know exists, but they still tend to underwrite it too lightly because they don't want to think it's going to happen to theirs. Oh, this property is great. It's always going to be vacated. But when your rental is vacant, the bottom line is the income goes to zero, but the expenses don't go to zero with it. You still have to pay the mortgage. You still have to pay the property taxes. You still have the insurance. You still have the utilities. You may still have other things like lawn care or snow removal. There may be HOA fees, or there's other holding costs depending on the property. And when a tenant moves out, you're not just losing rent for the days the property is empty, right? You have turnover costs that come into play then. You're going to have to get the property cleaned. You may need to paint it. There's going to be some repairs. You're probably going to change the locks. You're going to need to market the property again. There's going to be showing the property. You're going to need to screen those new tenants. You may have to offer some sort of concessions depending on what the market is doing. And then again, you have your time that's involved. So a lot of beginner investors assume a property will be vacant for a week or two and then rent it again immediately. And you know what? Sometimes that does happen, but oftentimes it does not. Sometimes the market's slower. Sometimes the property needs more work than expected. Sometimes the tenant pool is weaker than you thought. And sometimes the first tenant who applies is just not someone that you should approve. So vacancy cannot just be an empty line item on a spreadsheet. It's a real part of owning rentals. And if you don't price it right, price it in from the beginning, you may think you bought a cash flowing asset when really you bought a property that only works if everything goes perfectly. And it never does. It never goes perfectly. So that is not how I like to invest. Now let's talk about the tenants themselves. Again, I'm not saying that tenants are bad. There are great tenants. There are professional landlords who manage tenants very well. There are rental investors who have strong systems and strong screening and strong leases and strong management. But if we're talking honestly about rental properties, then we have to include tenant risk because tenants are one of the biggest differences between rental properties and other types of real estate investing. With rentals, your income depends on another person paying you every month and taking care of the property. Now, a lot of the times that works out just fine. But when it does not work, it can get expensive very quickly. A bad tenant can mean missed rent. It can mean late payments. It can mean property damage. It can mean complaints from the neighbors. It can mean legal notices. It can mean eviction. It can mean months of stress for you. And depending on the state, the eviction process can be fast or slow, can be simple or complicated, affordable, or it can get extremely expensive. You also have the emotional side of it that you need to take into account. See, most people do not get into real estate because they want late night calls or conflict or court dates or disputes with tenants. They get into real estate because they want freedom, they want wealth, they want passive income. But if you are self-managing rentals, these tenant issues can become very active very quickly. And even if you do have a property manager, you are still the owner. So that means you are still ultimately financially responsible. You're the one making the decisions. You're still the one that's paying for the repairs, for the legal fees, for the missed rent, and for that turnover. So when you analyze a rental property, you can't just ask, what is the rent? You also have to ask, what happens if the tenant stops paying? What happens if they move out? What happens if they damage the property? What happens if I need to evict them? What happens if this takes 3 months longer than I expected it to? Because one major tenant problem can wipe out months or even years of projected cash flow. Now, a lot of people hear this and say, well, that is why I will just hire a property manager. Then honestly, that may be the right decision. But property management is not magic, it's a cost. And it's not always just one simple fee. See, most people think of property management as 5% or 8% or 10% or maybe even 12% of collected rent. But you need to read the agreement. There may be a leasing fee when they place the tenant. There may be a renewal fee. There may be some sort of maintenance coordination fee. There may be a markup on repairs. There may be inspection fees. There may be setup fees. There may be cancellation fees. There may be eviction coordination fees. And none of those things are wrong. Property managers are running a business too, and they need to be paid for their work. But as an investor, you need to know what the real management cost is. Because if you underwrite 5% and then the real cost after all those fees is much higher, well, guess what? Your cash flow is now dramatically different. The other thing to understand is that hiring a property manager does not remove the responsibility from you. It removes some tasks from you, but it does not remove the ownership. You must still review the financials. You must still approve the repairs. You must still make decisions. You still must watch the performance. You still must make sure the manager is doing a good job. And if the property is not performing, well, you're the one that owns that problem. So management is a great tool, especially if you want to scale, but it needs to be underwritten honestly. If the deal will only work because you are pretending if the deal only works because you're pretending management is free, then it probably is not going to be working for you. This is another thing that gets missed. A lot of rental property content makes it sound like more doors automatically mean more freedom. And don't get me wrong, sometimes scale does create that efficiency. If you own enough units, then you get better vendor pricing. You may be able to justify better systems. You may have enough income to hire help. You may spread risk across more properties. But scaling also creates complexity. One rental is manageable, two or three rentals, probably still manageable. But as that portfolio grows, well, the number of moving parts for all of that grows too. More tenants, more leases, more renewals, more repairs, more insurance policies, more tax records, more maintenance schedules, more city or county rules that you have to follow, more accounting, more liability. All of these things mean what? More things that can go wrong. At some point, then, because of that, the portfolio starts to become an operation in itself. Again, that's not bad, but you need to be honest about it. If you want to own a rental portfolio, you're not just buying the assets, right? You're building you're building a management business. Now, that business may be run by you. It may be run by a third-party property manager. It may be run by an internal staff if you get large enough. But regardless of how it's run, there is an operating layer involved, and the operating layer comes with costs. So that is why some people do very well with rentals and others get overwhelmed very quickly. The people who do very well understand that they're building a business, not just collecting checks. The people who struggle often thought they were buying passive income. Instead, they really bought themselves a second job. Now, let's talk about taxes for a minute, because one of the benefits often associated with rental properties is depreciation. And depreciation is very powerful. It can reduce taxable income from the rental property and create paper losses, even when the property has positive cash flow. But this is where people need to be careful. A tax benefit does not mean that the deal is automatically good. See, tax complexity is still complexity. Rental property taxes can involve depreciation schedules. It can have passive activity rules. You could be doing cost segregation, repairs versus improvements, capital gains, depreciation recapture, 1031 exchanges, and then there's state-specific rules. Now, this is not something that you should casually guess on. You need a qualified CPA who understands real estate. Well, that means another cost. The other thing people miss is what happens when you sell the property. See, depreciation may help you while you own the property, but when you sell, depreciation recapture can become part of the tax picture. Capital gains can become part of the tax picture. State taxes can become part of this picture. If you do a 1031 exchange, then there's strict timelines and rules that you need to follow. And again, none of this means that rentals are bad. It just means that all of these numbers need to be looked at all the way through the deal. not just at the purchase. You're not just looking at the monthly cash flow, taxes during ownership, taxes at exit. See, a lot of investors based on the front end numbers, and then they get surprised throughout and then on the back end. So that's a huge mistake. The next hidden cost is the cost to sell the property. Most investors only think about buying. They think about rent, they think about cash flow, they think about that appreciation, but they don't always think about what it costs to exit. When you sell the property, there are going to be real estate agent commissions. There's going to be seller closing costs. There may be repairs or credits that are requested from your buyer. There may be transfer taxes, title fees, or attorney fees. There may be holding costs when the property is listed and under contract. There may be capital gain taxes you have to deal with. There may be depreciation recapture, like we talked about. There may be 1031 exchange costs if you're trying to defer the taxes. And the timing may not be perfect. You may want to sell when the market is strong, but maybe that doesn't work out. Maybe rates are high. Maybe buyer demand is lower. Maybe the property needs work. Maybe the tenant situation makes it harder to sell. Maybe the buyer pool is mostly investors, and investors are going to underwrite very aggressively, like we're talking about here. So you need to think about that exit when you buy. If a deal only works because you assume a clean sale at a strong price with low costs and no tax impact, then you're fooling yourself. Real estate investing is not just about getting into the deal. It's about getting into the right deal with the right exit options. Now let's compare this for a moment to land investing. See, this is where the cost structure is very different. With land, you do not have tenants. No one is living in the property or on the property, right, with land. No one is calling you because the toilet broke. And no one is damaging the carpet. No one is asking you to replace an appliance. No one is refusing to pay rent. No one needs to be evicted. There's no roof. There's no HVAC. There's no plumbing. There's no electrical system. There's no unit turnover. There's no carpet cleaning. There's no pink between tenants. There's no property management in the traditional real estate sense. Now, this does not mean that land is risk-free. It is not. Land has its own due diligence. You need to understand things like access, utilities, zoning, flood zones, wetlands, topography, buildability, road frontage, title, taxes, what the market demand is, proper pricing, who the buyer pool is, any restrictions, what's going on in the surrounding area, what can the property be realistically used for. So I never want somebody to watch this or hear this and think, wow, land is so easy and I don't need to know what I'm doing. That's not true in the least. But the cost structure is simpler. In many land deals, your holding costs are primarily property taxes and maybe some basic maintenance, depending on the property type and location, meaning lawn mowing and things like that. Now, if you buy correctly, you may be buying at a discount to the current market value. So you may have multiple exit options. You may be able to resell it for cash. You may be able to sell with owner financing and create monthly payments for yourself. You may be able to subdivide the property. You may be able to improve the property somehow or get it entitled to be improved. You may be able to hold it. You may be able to wholesale or double close it depending on the deal and your market. The point is not that land is always better than rentals. The point is that it's very different. And for investors who do not want tenants or repairs or evictions or the heavy management layer that we just spoke about, land can be a very attractive real estate strategy. And simply put, that's why we started focusing on it and have continued to focus on it all of these years. Now, whether you're looking at rentals or land, one of the biggest mistakes that beginners can make is using the best case scenario. They assume that rent will just be collected each and every month. They assume that repairs are going to be very low. They assume that their tenants are just going to stay put. They assume that taxes are not going to jump up. They assume that insurance costs will just happen to stay reasonable. They assume that they can self-manage it forever or that the management costs are going to be next to nothing. They assume that they can sell it very quickly if they need to. Right? They assume that the market will stay strong. All of that is not underwriting. That's speculating and hoping. And if you remember, or you've read about it or heard about it or whatever, depending on how old you are, but if you remember in 2008, a lot of people lost everything. And that was all because of speculation. See, good investing means asking what happens when things do not go perfectly. So with a rental, ask what happens if it's vacant for a number of months? What happens if a tenant moves out and I need to do $10,000 in repairs? What happens if my insurance costs go up? What happens if my property taxes increase? What happens if I need to hire professional management? What happens if I need to sell in a buyer's or a slow market? What happens if the actual cash flow is half of what I projected? Now, again, land is not negated. You need to ask yourself questions there too. Does it have legal access? Does it have physical access? Can someone build on it? Are utilities available? Is it in a flood zone? Are there wetlands? Is the topography usable? Are there any restrictions on the property? Who would the buyer for this property be? What are comparable properties like this actually selling for? How long are they taking to sell? What is my exit if my first plan doesn't work? See, this is the mindset that you need to have. The asset class can change, but the principles behind it do not. You have to understand what you are buying before you go out and buy it. So let's close this with a question that gets a lot of people into rentals in the first place. Is rental income passive? From a tax classification standpoint, rental income may be considered passive. But from a real life standpoint, it really depends. See, if you own one property and you self-manage it and you answer your tenant calls and you're coordinating repairs and you're handling renewals and you're tracking expenses and you're dealing with the vacancies and you're solving all the problems, it's not passive at all. Now, it may not be a full-time job, it may be part-time, and it may be worth it. It may build you wealth, but it is not remotely passive. If you hire a great property manager, it can become more passive, but then your return needs to support the management cost. If you scale into a larger portfolio with strong systems and good staffing and good management and having those strong reserves we talked about and having good properties, it can become even more passive at that ownership level. But again, at that point now it's a business, so that requires infrastructure. Now, land can be more passive in certain ways because there are fewer operational issues going on. Especially if you sell land with owner financing, you collect payments through a servicing company, and you have no tenants or structures to maintain. But again, land still does require that skill on the front end. You need to buy it right. You need to do your due diligence. You need to know the market. You need to structure the deal correctly. So the real question is not what strategy is passive. The question is which strategy has a cost structure, a workload, a risk profile, and a return potential that fits what I'm trying to build. For some people, that may be rentals. For others, it may be land. For others, it could be a combination of a lot of different things. But regardless of which path it is, you need to go in with clear vision. So here's the main points that I want you to take away from this. Number one, rental properties absolutely can build wealth, but the real cash flow is often lower than that beginner spreadsheet shows. Number two, a vacancy, repairs, tenant issues, management, taxes, time, and exit costs are not rare surprises. They are part of the rental property model. Number three, if you're going to invest in rentals, you need to underwrite those costs before you buy, not after they show up. And number four, land investing has a very different cost structure, which is one of the reasons that we like it so much. No tenants, no repairs to the structure, no evictions, no traditional property management layer. But you still do need to know how to evaluate the property. You still do need to understand access and zoning and utilities and flood zones and wetlands and titles and taxes and buyer demand and proper pricing. And that is where and why we put together our free due diligence playbook. If you want a guide to help you evaluate land deals before you buy, then you can download the free due diligence playbook. The link is in the description. And again, what I'd like to do is get some interaction here. I'd like to know your thoughts on this. So let me know in the comments. If you've looked at rental properties before, what hidden costs surprised you the most? And it may be more than one. Is it vacancy, repairs, tenant issues, property management, taxes, the time commitment, or is it something else? Drop it below. Let me know. And again, if you want more practical land investing lessons, deal breakdowns, and real world strategies like we're talking about here, make sure to subscribe to this channel. I'll catch you in the next video.